What if I told you that the average investor underperforms the very investments they own? Not because of the market, but because of themselves. The investor's worst enemy is himself. Benjamin Graham. In this episode of Macro Money Moves, we'll reveal the data they never show you, the cold statistical truth behind why most investors fail and how you don't have to. Underperforming the market by the numbers. Over the last 30 years, the S&P 500 returned nearly 9.7% annually. But the average U.S. equity fund investor, they earned just 6.8%. That's the finding from DALBAR's 2023 QAIB report, one of the most respected studies in behavioral finance. Let's break that down. A $100,000 investment in the S&P 500 would have grown to $1.58 million. But the average investor walked away with just $720,000. Same market, same timeline, very different result. And this isn't a one-off. Morningstar found that between 2012 and 2021, investors earned 1.7% less annually than their own fund's published returns because of bad timing decisions. Vanguard puts this behavior penalty at roughly 1.5% per year, costing investors billions. The behavior gap. Emotions erode returns. The market doesn't beat investors, investors beat themselves. The real enemy? Emotion. This pattern is so common it has a name: the behavior gap. It's the difference between what your investment could have earned and what you actually earned because you bought high and sold low. Take the dot-com bubble. NASDAQ surged 85% in 1999 and then lost 60% over the next 2 years. Many investors bought at the peak and sold in despair. Or the 2008 crash. Equity allocations peaked in late 2007 just before a 50% collapse. Investors fled at the bottom, just as an 11-year bull market began. This isn't just a U.S. story. Morningstar found that investors around the world exhibit the same timing errors. Whether in London or Los Angeles, human psychology doesn't change. Chasing returns and strategy switching. One of the most costly mistakes? Chasing past performance. We switch strategies constantly, from growth to value, tech to dividend, crypto to cash. But the results? Devastating. DALBAR found that frequent fund switchers earn just 3.5% annually from 1,984 to 2003, while the S&P 500 returned 13%. And it's not just funds. Sector ETFs, hot stock tips, niche themes, they tempt us to time the market. But data shows that volatile funds lead to larger investor return gaps because people panic or pile in at exactly the wrong times. Psychological traps. Why? We undercut ourselves. Behind these bad decisions are ancient instincts, psychological traps we're wired to fall into. We hate losses twice as much as we enjoy gains. So we panic at downturns, or refuse to sell a loser, hoping to get back to even. This drives the disposition effect. We sell winners too early and hold losers too long. It's the exact opposite of what smart investors do. We think we're better than average at picking stocks, timing exits, spotting trends. But the data says otherwise. In the classic study, trading is hazardous to your wealth. Active traders underperformed the market by 6.5% annually. Another, men traded 45% more than women and earned 1.4% less per year. These aren't isolated behaviors. They're universal tendencies. Biases like recency bias, confirmation bias, and herd behavior distort our judgment and cost us money. The investor's chief problem, and even his worst enemy, is likely to be himself. Benjamin Graham. Tax avoidance, when good intentions backfire. Even well-meaning strategies can backfire, like avoiding taxes at all costs. Say you hold a big winner, a stock you bought early that's now grown 10x. You know it's time to diversify, but you hold on to avoid paying capital gains tax. Then the market corrects and your gains vanish, all to dodge a one-time tax. Studies on capital gains lock-in show that investors often hold risky, concentrated positions for tax reasons and underperform as a result. Riverfront Investment Group modeled the math. Even with a 23.8% tax, switching to a better investment paid off in under 3 years. Taxes matter, but they shouldn't control you. The goal is to maximize after-tax wealth, not minimize your tax bill. How not to be most investors. So why do most investors fail? Not because they lack intelligence, not because the market is rigged, but because they're human. They switch strategies at the wrong time. They let fear and greed drive their decisions. They chase trends, flee downturns, avoid taxes, and overestimate their own skill. And the data proves it. But you don't have to be most investors. The solution isn't some secret hedge fund formula. It's simple. Have a plan. Stick to it. Tune out the noise. Let the math and your patience work for you. Thanks for watching Macro Money Moves. If you found this valuable, subscribe for more data-driven breakdowns of what really moves your money.